Hey everyone, welcome back. Today we're diving into some big news coming out of China. So on October 18th, China's central bank, the People's Bank of China, launched two new funding schemes that could pump up to 800 billion yuan, which is about $112 billion into the stock market. This is a big move, so let's break down what's going on and why it matters. Okay, so here's the deal. The Chinese stock market had a bit of a bull run not too long ago, but things started to slow down. A lot of people were getting cautious because even though the government promised stimulus, it felt like they were dragging their feet on actually doing anything big. And, people were like, where's the action? Where's the follow through? Well, this announcement was the action that investors had been waiting for. It's like the government is saying, all right, we hear you. Here's the support. So there are two schemes here. The first one is a swap scheme worth 500 billion yuan. The way it works is that brokerages, asset managers, and insurers can get liquidity, basically cash, from the central bank by putting up collateral like bonds, stock ETFs, and other assets. In simple terms, it's like they're borrowing money by temporarily exchanging their assets for cash. Then they use that cash to buy more stocks. Pretty clever, right? What's cool about this is that it acts as a stabilizer for the market. Think of it this way. If stocks are oversold and the market's tanking, instead of everyone panicking and selling off their shares, these big players can use the swap scheme to get some cash without dumping their stocks. That way, they don't make the market crash even more. So, it's like a safety net for when things get rough. Now, this isn't just theory. 20 companies have already been approved to participate, including some big names like China International Capital Corp and CITIC Securities. And the demand is already high. Applications have exceeded 200 billion yuan, which shows people are ready to use this tool. Then we've got the Relending scheme. This one is worth 300 billion yuan. And here's how it works. Financial institutions can borrow from the central bank at a super low interest rate, just 1.75%. They can then lend that money to listed companies or their major shareholders at a slightly higher rate, up to 2.25%. And this is the key part. The companies use that money to buy back their own shares or make new share purchases. Normally, Chinese banks aren't allowed to lend money for stock market investments. So this is a bit of an exception to the rule, and it shows how serious the government is about supporting the market. And we're already seeing companies jump on this. For example, last week, a company called Beijing Balance Medical Technology announced that its controlling shareholder plans to use the relending scheme to buy its own shares. So this isn't just theoretical, it's happening. Now, what's the goal of all this? Well, it's about stabilizing the stock market and boosting confidence. If more companies buy back their shares or make new investments, it drives up demand, which can push stock prices higher. And if implemented effectively, BNP Paribas says these new efforts could bring in more money and help raise stock valuations. Basically, it's a way to keep the market from tanking further and maybe even turn things around. So, for investors in China, this could bring some much-needed optimism back into the market. That's the big picture. We're talking about a government that's willing to step in and support its stock market in a pretty direct way. But of course, the real test will be how well these policies are implemented. Will it be enough to stop the slide and reignite a bull market? Only time will tell, but it's definitely a bold move. So, what do you think? Do you think this is going to work, or is it too little too late? Let me know your thoughts in the comments below. Thanks for watching, and I'll catch you in the next video.